December 2025, buried in a routine monthly report from the US Treasury Department is a number that should be making headlines but is not. China now holds $775 billion in US Treasury securities. That sounds substantial until you realize that 12 years ago, they held $1.3 trillion. They have sold over $520 billion of American government debt. Russia's position is even more dramatic. In early 2018, Russia held $96 billion in treasuries. Today, less than $2 billion remains, a 98% liquidation. If this were just one country adjusting its portfolio, it would be unremarkable. But when the world's second largest economy and one of the largest energy exporters both execute the same strategies simultaneously, dumping over $600 billion in dollar assets while accumulating over 1,000 tons of gold, that is not a coincidence. That is a coordinated exit. And it represents the unraveling of a system that has governed global finance for 80 years. To understand what is happening right now, you have to understand how the system was built. Because the dollar's dominance was never inevitable. It was engineered deliberately in 1944 at a hotel in New Hampshire, designed to give the United States permanent economic advantage, and is now collapsing under the weight of contradictions that were built into its foundation. This is the story of how the dollar became the world's reserve currency, why that system is now breaking down, and what history tells us happens when a reserve currency loses its status, because we have seen this before, and the pattern is unmistakable. July 1944. World War II is still raging across Europe and the Pacific. But representatives from 44 allied nations gather at the Mount Washington Hotel in Bretton Woods, New Hampshire, to design the post-war financial system. The conference is dominated by two men. John Maynard Keynes, representing Britain, and Harry Dexter White, representing the United States. Britain enters the conference as a debtor nation, exhausted by war, dependent on American loans. The United States enters as the world's largest creditor, holding 2/3 of the world's monetary gold. The outcome is predetermined by this power imbalance. The Bretton Woods Agreement establishes the US dollar as the global reserve currency. Every other major currency will be pegged to the dollar at fixed exchange rates, and the dollar itself will be convertible to gold at $35 per ounce. This arrangement means several things. First, it makes the dollar as good as gold because it can be exchanged for gold on demand. Second, it means every nation needs dollars to conduct international trade. Third, it gives the United States the ability to print the world's money, an advantage no nation has possessed since the Roman Empire. But Bretton Woods contained a fatal flaw. It required the United States to maintain enough gold reserves to back all the dollars circulating globally. As long as the US ran modest deficits and maintained fiscal discipline, the system would hold. But if America printed too many dollars relative to its gold holdings, the promise would become unsustainable. And that is exactly what happened. In the 1960s, the United States was fighting an expensive war in Vietnam and funding massive domestic programs. The government was spending far more than it collected in taxes, and it financed the difference by printing money, lots of money. Foreign governments noticed. In 1965, French President Charles de Gaulle publicly questioned whether the United States had enough gold to back all the dollars in circulation. He began converting France's dollar reserves into gold, demanding physical bullion be shipped from New York to Paris. Other nations followed. Germany, Switzerland, the Netherlands. Gold was flowing out of Fort Knox faster than it could be replenished. By 1971, President Richard Nixon faced an impossible situation. Foreign governments held more dollars than the United States had gold to redeem. If everyone demanded gold at once, America would default. The entire Bretton Woods system would collapse. On August 15, 1971, Nixon appeared on national television and announced that the United States would temporarily suspend the convertibility of dollars into gold. Temporarily was the word he used. It has now been 54 years. The suspension is permanent. Overnight, the dollar became a fiat currency, backed by nothing except the promise of the US government. The question was whether the world would continue using a currency that was no longer backed by gold. And the answer came 3 years later in a secret deal made in the Saudi desert. The dollar after 1971 was vulnerable. Without gold backing, it needed something else to ensure global demand. In 1973, the OPEC oil embargo created a crisis and an opportunity. Oil prices quadrupled, and Western economies faced paralysis. Henry Kissinger, U.S. Secretary of State, recognized that if the United States could ensure that oil, the most essential commodity in the modern world, was priced exclusively in dollars, then every nation would need dollars to buy energy. That would create permanent structural demand for the currency, replacing the gold backing that had been abandoned. In 1974, Kissinger made a secret trip to Saudi Arabia. The details of those meetings remain partially classified, but the outcome is clear. Saudi Arabia agreed to price all of its oil exports exclusively in US dollars and to invest surplus oil revenues in US Treasury securities. In exchange, the United States provided total military protection to the Saudi royal family, guaranteeing their security with American power. By 1975, the rest of OPEC followed Saudi Arabia's lead. The petrodollar system was born. Every nation that needed oil, which was every nation on Earth, was forced to acquire and hold dollars. This created the same permanent demand that gold backing once provided, but without the constraint of limited gold reserves. The United States could now print as many dollars as it wanted, because global oil demand ensured those dollars would be absorbed. For 50 years, this system has endured. It has allowed the United States to run enormous budget deficits without facing the currency collapse that would destroy any other nation. It has enabled Americans to consume far more than they produce, with the difference financed by the rest of the world's need for dollars. But every system built on artificial advantages eventually faces a reckoning. And that reckoning is happening now. The first cracks appeared not from economic policy, but from the weaponization of the dollar itself. For decades, the United States used its control over the dollar financial system as a tool of foreign policy. If a country defied Washington, it could be cut off from dollar transactions, frozen out of the SWIFT international payment system, and have its dollar assets seized. This was effective coercion, but it taught every nation that holding dollars was not just an economic decision. It was a political vulnerability. The turning point came in February 2022, when Russia invaded Ukraine. The United States and European Union responded by freezing approximately $300 billion in Russian central bank reserves. Overnight, Russia's savings, accumulated over decades of oil exports, became inaccessible. It was the largest financial seizure in history, and every government on Earth took notice. If the United States could freeze Russia's reserves with the stroke of a pen, it could do the same to anyone. Dollars held in Western banks were not safe reserves. They were hostages. China watched this closely. Chinese leaders understood that if they ever moved on Taiwan, the American response would include similar financial sanctions. Freezing reserves, cutting off access to dollars, ejecting Chinese banks from SWIFT. This was not paranoia. American officials had discussed these exact measures publicly. And so China, along with Russia and other nations wary of American financial power, began preparing for a world where the dollar could no longer be relied upon. The preparation took three forms: liquidating dollar assets, accumulating gold, and building alternative systems. The data is public and undeniable. According to the US Treasury's TIC reports, Treasury International Capital Data, China's holdings of US Treasury securities peaked at $1.316 trillion in November 2013. By December 2024, that figure had fallen to approximately $775 billion. A reduction of $541 billion over 11 years, but the pace of decline has accelerated dramatically. Between 2021 and 2024 alone, China sold over $280 billion in treasuries, more than half of the total reduction compressed into just 3 years. Russia's exit was even more abrupt. In April 2018, Russia held $96.1 billion in US treasuries. By May 2018, that had fallen to just $14.9 billion. In a single month, Russia liquidated 84% of its dollar bond holdings. By 2020, holdings were below $10 billion. Today, less than $2 billion remains. This was not panic selling during a crisis. Russia began dumping treasuries before the major sanctions hit. They saw what was coming and exited preemptively. That is strategic repositioning, not reactive panic. Other nations have followed. According to aggregate TIC data, total foreign holdings of US Treasury securities represented 34% of all outstanding treasuries in 2015. As of late 2024, that figure is approximately 29%, a decline of 5 percentage points. That translates to nearly $2 trillion in bonds that foreign buyers no longer want. The question is, where did that money go? And the answer is visible in central bank gold reserves. According to the World Gold Council, central banks purchased 1,045 tons of gold in 2023, the highest annual total since 1967. In 2024, purchases exceeded 1,100 tons. This is not normal behavior. For decades, central banks were net sellers of gold, viewing it as a barbarous relic with no place in modern finance. The reversal is stark and coordinated. Russia increased its official gold reserves from approximately 400 tons in 2007 to over 2,330 tons today, making it the fifth largest sovereign holder globally. The bulk of that accumulation occurred after 2014, after Crimea, after sanctions began, after the threat of being removed from SWIFT became real. China officially reports holding 2,264 tons of gold. But analysts who track import flows, domestic production, and Chinese gold market activity estimate actual reserves are far higher, likely between 3,000 and 4,000 tons. China is the world's largest gold producer, mining approximately 370 tons per year, and by law, none of that gold can be exported. It stays within China. Additionally, gold held by state-owned enterprises, sovereign wealth funds, and other government-controlled entities does not appear in the official central bank total. The real figure is almost certainly double what is publicly reported. This is not portfolio diversification. This is strategic preparation. Nations do not liquidate hundreds of billions in dollar assets and accumulate thousands of tons of gold unless they are preparing for a monetary system where the dollar is no longer dominant. But gold alone does not replace the dollar's function in global trade. To truly move away from dollar dependence, nations need alternative payment infrastructure. And that infrastructure has been built over the past decade. In 2015, China launched CIPS, the China International Payment System. It functions as an alternative to SWIFT, the Belgium-based network that processes the majority of international dollar transactions. CIPS now connects over 1,400 financial institutions across more than 100 countries. In 2024, it processed over $17 trillion in transactions, up 50% from the previous year. Russia developed SPFS, the System for Transfer of Financial Messages, as its own SWIFT alternative. It currently connects 159 foreign banks across 20 countries. Transaction volume has grown 60% year over year. These are not theoretical backup systems. They are operational networks processing real transactions right now. And critically, they do not require dollars. Transactions can be settled in yuan, rubles, euros, or any other currency the participants agree upon. Then there is the petro-yuan. In 2022, Saudi Arabia began accepting Chinese yuan for oil payments. This was a seismic shift. For 50 years, the petrodollar system ensured that all oil transactions required dollars. But according to recent reports, approximately 20% of China's oil imports are now settled in yuan, up from less than 2% in 2020. And in 2024, Saudi Arabia formally joined BRICS, the economic bloc consisting of Brazil, Russia, India, China, and South Africa, along with new members including the United Arab Emirates, Egypt, Ethiopia, and Iran. BRICS now represents 42% of global oil production, 36% of global GDP measured by purchasing power parity, and 41% of the world's population. At the October 2024 BRICS summit in Kazan, Russia, member nations signed a declaration stating their support for strengthening correspondent banking networks and enabling settlements in local currencies. This is diplomatic language, for we are moving away from dollar dependence. The infrastructure exists, the volume is growing, and every month, more transactions shift from dollar-based systems to alternatives. History provides a clear precedent for what happens when a reserve currency loses its status. Because the dollar is not the first global reserve currency. It is merely the most recent. Before the dollar, the British pound sterling dominated international finance for over a century. In 1900, the pound represented more than 60% of global central bank reserves. Britain controlled the largest empire in history, dominated global trade routes, and London was the undisputed financial capital of the world. By 1976, just 76 years later, Britain was forced to request a bailout from the International Monetary Fund because it could no longer defend the value of its currency. What happened in between? 3 distinct phases. Phase 1 was creditor loss of confidence. Britain emerged from World War II as a debtor nation. The costs of fighting had exhausted the Treasury, and Britain owed enormous sums to the United States. As Britain continued running deficits, creditors began doubting the pound's value. In 1967, France under Charles de Gaulle demanded gold in exchange for the pounds it held, forcing Britain to choose between defending the gold peg and printing money to cover debts. Britain chose printing, the pound was devalued. Phase 2 was alternatives emerging. The German Deutschmark and the US dollar became preferred currencies for international trade. Central banks quietly shifted their reserve compositions, reducing pound holdings and increasing dollar and mark holdings. The pound's share of global reserves fell from 65% in 1950 to under 20% by 1980. Phase 3 was accelerating transition. The decline was not linear. It was exponential. Once the trend became obvious, everyone rushed for the exits simultaneously. The final collapse from a functioning reserve currency to an IMF bailout took less than 2 years. From 1974 to 1976, confidence, once lost, evaporates rapidly. Now look at where the dollar stands today. According to IMF data, the dollar represented 72% of global central bank reserves in 2002. As of the third quarter of 2024, that figure is 58%. A 14 percentage point decline in 22 years, but the rate of decline is accelerating. Between 2002 and 2018 years, the dollar lost 10 percentage points. Between 2020 and 2024, just 4 years, it lost another 4 percentage points. If this acceleration continues, the dollar will fall below 50% of global reserves sometime between 2028 and 2030. And that number matters because reserve currency status is not linear. It operates on network effects. As long as everyone believes the dollar is dominant, it remains dominant because everyone continues using it. But there's a tipping point. Economic research suggests it sits around 50%. Once the dollar's share of reserves drops below half, the network effect reverses. The advantages of dollar usage diminish. Holding dollars becomes a liability rather than an asset, and the exit accelerates into a stampede. History shows that the transition from initial creditor loss of confidence to full-blown currency crisis takes 8 to 12 years. China began significant treasury reductions in 2013. Russia accelerated its exit in 2018. That timeline places the danger zone directly ahead between 2026 and 2032. The fundamental problem is mathematical. The United States currently has a national debt exceeding $36 trillion. Annual interest payments on that debt now exceed $1.1 trillion, making debt service the third largest item in the federal budget after Social Security and Medicare. And the debt continues growing. The federal government runs deficits exceeding $1 trillion annually, adding to the total every single year. The Congressional Budget Office, the nonpartisan federal agency that projects government finances, released long-term projections showing that by 2034, national debt will reach $54 trillion, with annual interest payments exceeding $1.7 trillion. Those projections assume interest rates average 3.6% over that period. But current 10-year Treasury yields are above 4.5%. If rates remain at current levels instead of declining as the CBO assumes, the interest burden will be far higher, potentially exceeding $2.4 trillion annually by 2034. At that level, interest payments alone would consume nearly half of all federal tax revenue. The government would face a binary choice. Keep interest rates elevated to maintain some degree of price stability, but watch the budget implode as interest costs crowd out all other spending. This leads toward default, perhaps not officially declared, but functionally real as obligations cannot be met. Or suppress interest rates through massive Federal Reserve bond purchases, preventing immediate default, but igniting serious inflation that erodes the currency's purchasing power. There is no third option. Both paths destroy wealth. The only question is whose wealth gets destroyed and through what mechanism. China and Russia evaluated this equation years ago. They concluded that the United States will eventually choose inflation over default because inflation is politically easier. It is a hidden tax that most voters do not understand until it is too late. Default is explicit and catastrophic. Inflation is gradual and deniable. Governments always choose inflation. And so China and Russia exited dollar assets before the trap closed. What we are witnessing is not the sudden collapse of the dollar. It is the slow unwinding of a system built on unsustainable advantages. The Bretton Woods gold backing ended in 1971 when the math stopped working. The petrodollar system that replaced it is ending now, as major oil producers accept alternative currencies, and the weaponization of dollar access has taught nations that dollar dependence is a strategic vulnerability, not a safe haven. The historical pattern is clear. Reserve currencies do not collapse overnight. They decline over decades as creditors lose confidence, alternatives emerge, and the transition accelerates. The British pound lost reserve status over 30 years, from the late 1940s to the late 1970s. The dollar is following the same trajectory. The decline began in the early 2000s when the dollar's share of reserves peaked. It accelerated after the 2008 financial crisis when the Federal Reserve printed trillions to bail out banks. It accelerated again after 2022 when Russian reserves were frozen, demonstrating that dollar assets could be weaponized. The question is not whether the transition will happen. The question is how fast and how disruptive it will be. If it follows the British pound precedent, the process takes another decade or more, with the acute crisis phase lasting 2 to 3 years. If confidence breaks more suddenly, if a major debt ceiling crisis triggers a U.S. credit downgrade, if a confrontation over Taiwan leads to large-scale sanctions, the timeline could compress dramatically. The infrastructure for a post-dollar system already exists. CIPS and SPFS are processing transactions. The petroleum is operational. BRICS nations are coordinating trade in local currencies. Gold is being accumulated at record rates. The system is not coming, it is here. It operates in parallel with the dollar system, and every month, more volume shifts from one to the other. The central banks executing this shift are not ideological. They are not driven by anti-American sentiment. They are driven by mathematics and self-preservation. They see the same Congressional Budget Office projections showing unsustainable debt growth. They see the same IMF data showing declining dollar reserve shares. They see the same risk that the United States will eventually inflate its way out of the debt trap, and they are positioning accordingly. Gold's role in this transition is straightforward. It is the only major asset that is no one's liability. Dollars are a liability of the U.S. government. Treasury bonds are a promise to pay. Euros are a liability of European governments. But gold is simply gold. It cannot be printed. It cannot be defaulted on. It cannot be frozen by a foreign government. When confidence in fiat currencies declines, gold is where capital flows. And central banks understand this, which is why they are buying it at rates not seen in over 50 years. Current gold prices sit around $2,650 per ounce as of late 2024, but supply and demand fundamentals suggest significantly higher prices ahead. Global gold production is approximately 3,000 tons per year and has been essentially flat for a decade. The easy gold has been found. Meanwhile, central bank demand has exploded. If central banks want to increase gold backing of their reserves from current levels to even modest historical standards, they need thousands of additional tons. That demand cannot be met by current production. When demand structurally exceeds supply, prices rise until demand is rationed. That is not speculation. That is basic economics. The last comparable period of monetary instability was 1971 to 1980, when the Bretton Woods system collapsed and inflation surged. Gold rose from $35 per ounce in 1971 to $850 per ounce in January 1980, a 24-fold increase in less than a decade. Adjusted for inflation, that 1980 peak equals approximately $3,200 per ounce in today's money. Gold has not yet reached that inflation-adjusted level. If the current de-dollarization accelerates and we enter a period of genuine monetary crisis, historical precedent suggests gold could reach or exceed that level. The de-dollarization is not a conspiracy theory. It is not a prediction based on speculation. It is a documented process visible in official government data. China and Russia have liquidated over $600 billion in US Treasury holdings over the past decade. Central banks globally have purchased over 2,000 tons of gold in the past 2 years. Alternative payment systems that bypass the dollar are processing trillions in annual transactions. And the dollar's share of global reserves has declined from 72% to 58% in just over 20 years, with the decline accelerating. This is the unwinding of the system built at Bretton Woods in 1944 and modified in the 1970s with the petrodollar. That system gave the United States an extraordinary privilege: the ability to print the world's reserve currency and export inflation to the rest of the globe. But that privilege was always conditional. It depended on other nations believing the dollar would hold its value. It depended on the United States maintaining fiscal discipline. And it depended on the dollar system being the only viable option for international trade. All three of those conditions are now breaking down. The debt is unsustainable. Fiscal discipline is absent, and alternatives exist. The transition will not be smooth. Reserve currency shifts never are. When the pound lost its status, Britain faced a decade of economic stagnation, high inflation, and declining living standards. The United States will face similar adjustments. Imports will become more expensive as the dollar weakens. The government will lose the ability to borrow cheaply. Interest rates will rise. Inflation will be more persistent. The standard of living built on 80 years of dollar privilege will erode, but the process is already underway. It is not something that might happen in the future. It is happening now in real time, visible in the data if you know where to look. China and Russia are not guessing. They are reading the same data. And they have concluded that the dollar system cannot be sustained. Whether they are correct will be determined not by ideology or politics, but by mathematics. And the mathematics are unforgiving. 36 trillion in debt. 1.1 trillion in annual interest. A deficit exceeding 1 trillion per year. And a Federal Reserve with no good options. The unwinding of 80 years of dollar dominance is not a spectacle. It is a process. Slow, then fast. Gradual, then sudden. And the nations that prepared early by exiting dollar assets and accumulating gold will emerge from the transition in a stronger position than those who waited until the crisis was undeniable. History does not repeat precisely, but it echoes. The pound's decline offers the template. The de-dollarization follows the script. And the ending, as always, will be written in the wealth transfer from those who believe the old system would last forever to those who understood that nothing lasts forever, especially systems built on unsustainable mathematics.